Hi, I'm Keith Weiner, CEO of Monetary Metals and President of Gold Standard Institute USA. Today I want to talk about the dollar. Many people use the term fiat to describe the dollar, and that's true. Fiat means force, and the dollar is only accepted because of the force wielded by the US government. There's another aspect of the dollar, though, that I think is more important economically, which is that the dollar is irredeemable. So what do we mean by irredeemable? Well, if we compare to the pre-1933 era, when the dollar was redeemable, what did that mean? That meant that anybody with a $20 bill could come into any branch of the Federal Reserve Bank and redeem it by trading the paper across the counter and getting back a 1-ounce gold coin. In 1933, of course, as we all know, President Roosevelt suspended redeemability for US citizens. In fact, he made it illegal. It was a crime punishable by prison for possession of gold for US citizens, but continued the policy of allowing foreign central banks to redeem dollars for gold. Although he revalued the dollar at $35 an ounce, or devalued the dollar and increased the value of gold relative to the dollar. This policy continued through the 1960s, where the government of the United States was obliged increasingly to ship more and more gold overseas as more and more dollars were coming back. By 1971, this had reached a crisis level where gold was leaving at a rate of about 100 tons a day. Since at that point the United States government had about 8,000 tons, there was about 80 days remaining before the US government would have been completely cleaned out of gold. And so in 1971, President Nixon, quote unquote, closed the gold window, and as he said, temporarily. Of course, it wasn't temporary, it was permanent. And what this did was now it made the dollar completely irredeemable worldwide. The first consequence of this is that there's no longer a fixed redemption price of dollars for gold. The dollar price of gold can change, and of course does change, and now there's an entire industry of prognosticators predicting whether gold will be $1,700 an ounce in a year, or $2,500 an ounce, or $30,000 an ounce. Who knows? More importantly, an irredeemable currency is itself a debt instrument with no way of ever repaying. So picture an interest-only loan that can never be repaid, and at the end there's a giant balloon payment, and the only way to make that balloon payment is to go to the bond market and sell a new bond that pays off the old bond's principal plus the old bond's interest. And so today that is exactly the game that every debtor must play, is they go and sell new debt to pay off the old debt. And this means, and this is the unfortunate consequence, this means that today the debt is rising exponentially. From 1971, the debt was doubling about every 8 years, which is pretty serious if you think about it. Except that recently, in fact in November of 2012, the Treasury announced that the debt had doubled from February 2006. That means that the debt doubled in less than 7 years. And so not only is the debt rising exponentially, but the exponent itself is increasing. In the US, this process is still working. There's still a strong buyer for US Treasury bonds. But across the Atlantic in Europe, this is not necessarily so. The process is breaking down. Particularly in Greece, but also in Portugal and Spain and beginning in Italy now, the process is beginning to collapse. They cannot sell their bonds any longer, certainly not in Greece. So the problem is, of course, the monetary system is unchanged. Greece and all the other countries still have a need to sell their bonds, and yet they can't. So what happens? Well, to the rest of Europe, Greece's debts, Greece's bonds are assets. So if Greece were to default on these assets, the rest of Europe has a giant hole in their balance sheet. And so what they're obliged to do, increasingly, is the rest of Europe, through the European Central Bank and through their various bailout mechanisms, they're obliged to raise the debt and sell the bonds that Greece and these other countries no longer can do in order to provide the money to continue the monetary game a little bit longer, to take Paul Krugman's advice and kick the can down the road a little bit farther. They're still able to do that. The challenge is that the debt burden is still rising exponentially, and one by one, these countries that are able to participate in bailing out Greece and Spain and Portugal are themselves going to find that their bond markets close, their bond markets fail, and now they themselves are in need of a bailout. And so one by one, countries move from the bailout provider column to the bailout needing column, and eventually the entire thing is going to collapse and that's when the real crisis begins. The only two things we can say for certain are, one, dreadful losses are coming, and number two, the timing is uncertain, but I think drawing closer.